a sense of capital. Aloha, ladies and gents. Welcome back to a new episode of Live Earnings. Your host of today, as always, Julian, and I'm very glad to have you in. Guys, I initially want to say sorry for being late that strongly and not that well prepared. However, it is sometimes in life that you need to prioritize other stuff. And yes, investing in stocks is a great hobby. It's a great chance to achieve higher value and net worth. But on the other hand, sometimes other aspects in life are more important. So, however, I'm glad that I'm finally live, and I don't want to waste any time of you, not introduce too much the company we're talking about, because I guess everyone who's joining now the stream or later on watching the video, the episode, will be aware of what SentinelOne is doing. However, quick disclaimer at the beginning, as always, in the upcoming minutes, this will not be financial advice, consultation, or whatsoever, and there is no guarantee for correctness of the provided data. Okay, guys, let me quickly share my screen. We already see here the results are live. Actually, they are live since then, roughly 1.5 hours, so you are very likely way more informed than me. What is SentinelOne doing? Basically, they are a cybersecurity company, a vendor of different solutions for endpoint security, cloud security, and identity security, and some additional data and AI processing services. As you can see here in the overview, and they are doing this with a Singularity platform through a let's say one-stop shop solution. Yeah, that is what Sentinel is doing. They do this for private companies, maybe in the future as well for the governments. Let's see. But that's the current status. And what I've checked already is that SentinelOne is tumbling quite strongly. I didn't check the details, but I assume, there have been high hopes and expectations due to the Crowdstrike outage and the potential gains out of this struggle their main competitor Crowdstrike is confronted with, and because of several other informations which have been published in the past, and I think just general market assumptions. And so I assume that those expectations have been too high, because otherwise the stock would not be after market now roughly 14% in the red. But we will check out in a moment why that's the case. Before we jump into the details, I prepared as always my Excel sheet, and you can see here, top and bottom line growth when we talk about earnings per share, so the profit side. The forecast was 0.01 US dollar. I want to see roughly a beat by as well 0.01 US dollars. So overall we're talking about EPS of 2 cents, US dollar cents. And revenue, the target is 200, let's say roughly 210 million US dollars for the third quarter 2024, and I want to see a small beat, not a strong one, just roughly talking about 4 million. So my target is 240 million US dollars revenue. That's top line, bottom line. So one more time, earnings per share 2 cents, and revenue 240 million US dollars. That would be definitely my desired number. And about the details, we will screen them together a moment after. So guys, again, as I mentioned and promised, not wasting too much time going in. And guys, one addition, that's not the first time that I'm invested and this kind of drops happens. I was invested more than 1 year ago for a certain period of time. And I can already tell now that I love to be invested into the cybersecurity space. It's my favorite sector overall. Even though if maybe the company is not developing perfectly, doesn't mean for me, at least instantly, that I want to sell this investment. But we will see. Maybe it's that bad that I need to adjust what I've told you. So we open the shareholder letter. Here we go. $0.02 per earnings per share, but first we focus revenue and some further details. Okay, here we have the sheets with the superficial top numbers, and the revenue is $211 million. Revenue grew 29% year over year. So that's definitely a beat. I mean, again, expectations have been, let me check those, have been 209.7, and now it's 210.6. So I think that's actually not that bad, as you can see here. So I assume that's not the reason why. I mean, maybe the market expected a stronger beat, because that's definitely not a strong one, just by 1 million. When you compare it to 1 year ago, talking about a beat of 9 million roughly, if I'm not 8 million, and just 1 million now. I'm not sure if that's the reason. Let's see, maybe it's as well about the forecast, full year outlook, maybe. So Q4 development, maybe it's as well because of the development of the margins, profit side, but this is what we will check out together in a moment. Yeah. So I would not want to waste any time, as I mentioned, zooming a little bit in so it's easier to follow the numbers, and start to enter the information into the prepared earnings sheet. So $211 million. We have it here. Going back to the Excel and entering it. Unfortunately, that's on the first glance obviously not what I wanted to see. But at least it's a beat, that's for sure. Then let's check out what is going on with the earnings per share. I hope we can quickly calculate it out by ourselves. Let's check out income. Net income, here we go. Is it? Please give me a moment. And stay patient. So okay, look guys, I tried to figure out the numbers by Seeking Alpha investment platform, what I definitely can recommend. And we can see here the exact revenue number is 210.6 million, but more important, earnings per share is a miss. It's minus 0.25, so quite a strong miss, guys. And I assume that is already one big reason why the stock is dropping up after market. So let's enter those numbers one more time. We have it here. Correct this number to 209.6 and 0.25. Is this actually correct? I mean, if that's really the true number, then it's a strong miss. Actually, I can't even imagine that that's correct. But okay, then let's try to calculate it by ourselves. Net income, we got it here. Let me take a quick screenshot. Okay, net income. I think they used the non-GAAP, so it's minus 11 million. Enter it into the Excel. Entered and shares outstanding. I hope we can find them quickly. looks good. And is it the correct number? Yes, looks good. 316. 987 03. Okay, so my result is actually definitely a better one, and I assume it's correct. Let me quickly check this one as well. Just try to figure out what is the true. Yeah, I mean, when I check another article, it's basically proving or confirming that they lost this 25 US dollar cents per share. I mean, look guys, if it's more or less, let's say like this, it's definitely, it's not about this. I mean, I expected a positive one. I think the market expected a positive one, and no matter if it's this kind of big miss, if that's correct, guys, check it out by yourself, calculate it out by yourself. But I mean, if it's a miss, it's a miss, and that already means for me that when I need to rate it, it's definitely negative. Yeah, so there's no doubt about it. So that's actually for sure not a good start into this earnings results. About revenue, I want to judge in a moment, but first I want to enter the other numbers because I want to see, okay, what is going on with the forecast. But this is what I will add later on, or maybe, come on, let's do it right now. Let's do it right now. Check out, going back to the shareholder letter. And let's see where they are addressing guidance. Page 13. Okay, here we go. Q4 is 222 million. And full year 880 million. We cover this in a moment. But first, let us enter the 222 million. So my expectation, look, I wanted to see that they have a jump on a similar scale like 1 year ago, quarter on quarter, comparing Q3 and Q4, the actual results of Q3 and the Q4 forecast or guidance, and you can see the difference is roughly 13 million. So I want to see something like this, forecast on forecast. And so now I want to see something like 223 million US dollars. Now it's 222 million. That's still in an okay range in my opinion. Not too shabby, not too bad. However, both numbers are definitely not somehow compelling. Hard to say. I mean, honestly, I expected a higher beat. Honestly, I expected a higher forecast, even if it was a slight one. But based on the actual results of Q3 in terms of revenue, and just a very, very small beat, not a strong beat like with 8 million. Look guys, I rated negative. Yeah, I mean, it's not the end of the world, as I mentioned a moment ago. That will not be the reason, or that very likely will not mean that I will sell the stock right after the session, after market or tomorrow morning. However, it's definitely not looking very convincing, and yeah, so far not so good actually. But let's step in and go a little bit deeper, dig a little bit deeper about the different parameters of this company. And so now we will focus how much diversification is taking place. So what are the sources of the income? Is it just very focused on the US, or is actually the international revenue growing? What I would prefer, so they are a little bit more diversified, and the risk just depending on one region for the success, what can be very beneficial if the region is going well, but what can be very negative if the region is not going well, is definitely higher, this risk. So I would love to see that the international revenue is solid, on a solid base, or even growing. So 37% was the Q2 result. We check out what is going on, and we stay on 30 international revenue represented, reflecting year-on-year growth. We stay on 37%, as you can see here. Going back to the table, entering this, and you can see 1 year ago it was basically as well 37%. So not that much happened, but it's okay. It's from my perspective an okay number. I don't see the need that it's somehow increasing that strongly. I would love to see it, but if it stays solid, it's fine for me as well, and therefore I grant here a neutral rating. Yes. Okay, guys, and now we check out the annual recurring revenue. So basically the key KPI for SaaS, for software as a service company. So basically really with this long-term constant agreements, what is basically the primary definition of a SaaS company. We want to see that this is growing, so this very well calculatable and expectable and forecastable number is as well on a good growth level. You can see last quarter year-on-year growth, it was roughly 32%. I think that's already a very high level. Let's see what they can manage right now. I mean, that's even a more important number actually than the revenue itself, because actually again that's the we are already here, and we're talking about 29%, so it's 3% points down. However, talking about 860 million US dollars expected on the current status. 860, or forget a few zeros. Got it. And again, yes, that doesn't look that strongly, but again, we should not forget that, I mean, at least when we take a look at the quarter ago with 32%, but you can see revenue growth is just 28.4% year over year, and the ARR growth is actually stronger, and I love to see this. I love to see that there's kind of a gap. You can see the quarter ago year-on-year growth, revenue growth was stronger than the ARR growth, and this now has shifted, and that is actually a positive sign. However, it's still lower year-on-year growth than the quarter ago, so I rate this as neutral, but again with a little bit more, actually maybe even with a tendency to the positive, because I love to see that the ARR is higher than the base revenue growth. Let's see what is going on with the 100,000 US dollars plus ARR customers, how they developed. So basically, I mean, the roots of SentinelOne is more on a small, medium cap customer base, but they want to expand more and more to the large caps and to the big enterprises, and let's see if they can make it happen. So we go back and check out what is going on here, if we can't find it quickly. think we can see it on the first page, if I'm not mistaken. And there are all the informations. To record, that's nice to see. Added a record number of 100,000, which grew 24% year-over-year, so 1,300. Okay, 1,310. 1,310, and let's see how this looks. And we can compare it here. Last quarter, 24% year-on-year growth. This quarter, roughly 24% year-on-year growth. So not the big steps, but I like to see that the growth is constant and it's not decreasing that heavily, like we watched a moment ago, or took a focus on the ARR itself. So I think that is actually quite positive. Not too positive, but for me definitely a neutral scale. So however, so far, I mean, the detailed results doesn't look that bad. And now we take a look on the cost side of the business, on the general administrative expenses, and research of development and marketing and sales expenses, basically, starting with G&A. And for sure, when you compare those numbers with the competition, there's definitely room for improvement. So let's see if this improvement is taking place. And maybe here's another reason why the profit base is so bad, or the earnings per share, because maybe the expenses are not developing as expected. But we will figure it out. So they showed us always with some illustrations, with some kind of a pillar diagram. And we have it here, and I always take a focus on the GAAP results. If I'm not mistaken, yet looks good. So starting with G&A, and G&A we're talking about, here we have it, taking a focus on the gray part of it, 25%, so it's definitely decreasing. We will see how strong it's decreasing, especially compared to last quarter year-on-year. So 25%. Taking the number, entering it, going back, taking a look at sales and marketing. Sales and marketing, as you can see here, is the black bar, and you can see actually here the level of lowering the percentage compared to the revenue is definitely just 1%, and therefore very, very low. And yeah, maybe they're getting more aggressive. Maybe they want to utilize the outage, the weakness from their major competitor, from Crowdstrike. Maybe the overall sector getting more competitive. Palo Alto, for instance, this kind of players getting more aggressive and more competitive. So that might be the reason. I mean, it can be kind of an investment into the future to be aggressive with sales and marketing if it's invested and addressed into the right direction. So that's always another topic. Can't promise this, of course, or it's hard to check this. But however, we can just see that the development is not that strong, and that is what we can judge right now about. Let's say like this. And so entering 59%. But at least it's getting lower. And now, last but not least, general administration, research and development. Here we have it, and actually it's increasing. Yeah, so that might be really an investment into the future. Maybe staff costs are increasing because of inflation. Who knows? Yeah. So by 1% up, actually, that is of course something what we don't like to see. We want to see the company getting more and more efficient. Again, yes, if it's paying off in the future and the results are great, then it was worth it. But yeah, I personally don't like that it's increasing. However, we're starting with the general administrative costs, and when we take here a look, you can see it decreased compared to last quarter by minus 6%. But the decreasement was way stronger a quarter ago, year on year, with 10%. And that is what you can see here on the first glance on the actual numbers. So past quarter we talked about 22%. There in the prior quarter 23%. Now it's 25%. Yeah, it's lower than 1 year ago, as you can see here, with this 31%, but not compelling, guys. And I would love to see it's getting lower than compared to Q2. So for me, that's a negative. And yeah, this original idea, or this assumption that maybe this earnings per share is related to the expenses side, I mean, which is obviously very reasonable or very obvious that that's the case. You can see here's the proof already when we take a focus on the G&A, and maybe sales and marketing is even worse. Let's see what is going on. And yes, we can see it. Past quarter year-over-year growth -6%. Now only -1%. That is not what we like to see. And we want to see that the company is starting to make money, getting more efficient, and start to creating profit basically, and cash, of course. And that's more difficult when the expenses are that high. Yeah? So yes, they lower it compared to past quarter, but more or less you can see it's stable since 1 year. Yeah, so past 5 quarters it's stable, not that compelling. Here again, I rate it negative. Now we check out the research development, and that actually increased. Yeah, increased. You can see past quarter year growth -4%, now 1% up. Again, we don't know if it's worth it or not. It can be investment in the future if they work on their solutions. Yeah. But maybe it's because of not existing efficiency or something like this. Can be many reasons why that's the case. However, what we can see is it's going up. Don't like to see it. We need to be strict here, or I at least. Just my entertaining perspective, let's say it like this. You need to do your own research. But however, we can see it till now. Everything I rate negative. Now we're checking out the operating expenses per share of revenue, and of course it's obvious it's not developing that great if all the detailed numbers are not that good. Yeah, you can see last quarter year-over-year -20%, which was basically amazing and created a lot of tailwind. Now it's just 6% minus. Yeah, at least it is 6%, but it is not what we like to see, especially if this number is still higher than the revenue. Yeah, so yeah, nothing too new here. So this expenses side is straight negative from my perspective. I don't see any positive here. Yes, I can read now the details of the letter. I will do this tomorrow with a little bit more time after work, and maybe there are good reasons for it, but numbers are not lying, let's say it like this. Yeah. Now we check out different margins, cross margins. So basically the costs directed directly to the products and services, operating income margin. These are the gross margin, plus considering as well those expenses, and free cash flow. So basically the money which is available really for granting dividends, lowering the debt, for instance, this kind of reasons, or buyback shares. Yeah, so another reason. So let's check out what is going on with those profitability numbers. And starting with the gross margin. Gross margin, here we have it. And we need to take, because I go for the GAAP and not for the non-GAAP version. You can see here GAAP is 75%, or non-GAAP as well on a solid scale with 80%. So that looks actually good on the first glance. Let's see what is going on. I mean, we would love to see it's going on with increasing it and getting more efficient. Obviously, that's not the case with all the costs, which are obviously going on. However, 75% is the number we have been looking for. 75% is the number we are adding. Taking a look now, comparing it, you can see here again, last quarter year-on-year growth 5%, now only 2%. Yes, but of course you're getting you're getting closer to kind of a peak, to a ceiling in terms of margin. 100% gross margin is obviously not realistic, and basically 2% year-on-year growth. Yes, again, not that strong, but I like to see it's growing. What I don't like is that it's constant compared to last quarter. Again, when we compare it here, Q2 2023 it was 70%, Q3 2023 it was 73%, so it actually increased by 3%. It's a little bit more difficult to tell from my side. I'm not sure if I should rate it negative or positive, but look, let's keep it positive. Let's neutral. Let's keep it rated neutral. Neutral or negative, of course, is the question. And I rated neutral, but definitely with a tendency into the negative area. Let's check out what's going on with the operating income margin. So here again, those costs are, or these expenses are as well considered. So here we are. Operating income margin, we are already right here, and now talking about 42% minus. That actually doesn't look that bad, but I assume that the jump in the past, the development was stronger. However, minus 42%. Again, going back, entering it. Yeah, and here we have basically the same scenario. You can see past quarter it increased by 27%, now just 8%, so definitely not that compelling. Yes, it's not anymore at minus 50% like 1 year ago, but it's still minus 42%. It's higher than last quarter. Yeah, not convincing me that much. So in this case, I rate it as negative, because before I was more on a neutral scale. Now I'm definitely more on a negative one. Let's check out what's going on with the free cash flow. Again, the money to buy back shares, grant dividend, or lower debt. So really the available amount of cash. And of course the margin based on the revenue. So let's see what is going on here. And free cash flow, we have it here already in the next page, so at least the numbers are well structured in their documentation files. And free cash flow margin, we have it actually it's first time positive. That is something what I like to see. 1%, so positive. Let's go back. And that can be, that's all, I mean, it's a message at least, yeah? So it's turning from, you can see it here as well, 7% past quarter year-on-year growth to 17% year-on-year growth this quarter, Q3 2024. I like to see this. I like to see it's positive. That's a nice message. And even if it's not that strong game changer, that is the first positive KPI I at least can find here at my documentation sheet. Now we come to the rule of 40. I mean, rule of 40 is a very popular number to compare SaaS companies to each other and see if it's worth to invest in it as an investor, basically as a business angel or something like this. Originally, this number, this rule of 40 KPI, is out of the startup investing, and regularly you're using the profit margin. But because, I mean, most out there in terms of this kind of SentinelOne stocks and earlier companies, they just use the free cash flow margin. We need to consider that profit margin, the result would be way more worse. Yeah, that's the truth. This one is way more clean because, for instance, stock-based compensation is not existing, is not considered here. So free cash flow margin is improving a little bit the picture. However, the good thing is we always use the rule of 40 based on the free cash flow margin in the past quarters, and so therefore at least the comparison to past quarter is on a neutral scale. And you can see that past quarter year on year it was actually minus 6%, and now it's up 3.4% compared to Q3 2023. And yeah, yes, it's slower than past quarter on an absolute scale, but again, it improved to past year, and not like past quarter it decreased. Yeah, so that's something which is nice to hear, nice to see. Still not that compelling. Again, of course, you want to see it's going positive, and yes, I mean, past quarter we talked about, I mean, big aspect again is not the free cash flow, big aspect is the revenue, because past quarter it was roughly 34%, now it's just 28%. So that's the major reason why this rule of 40 is that bad, not because of the free cash flow margin. This is developing well, very well, that was definitely positive. However, I mean, I want to see that this developing positive, and it's not, and that's the reason why I'm rating it negative. Yeah, want to be definitely strict here. Now we go on and take a look at the stock-based compensation expenses, that it's not that heavily and on a, let's say, manageable scale. So that's going back to the browser. Stock-based. Total expenses were 247, including 68 million stock-based compensation. Let's see if we can have a more accurate number. If not, I take the oh, see here it's 70 million. Let me check what is the right number. I will have it in a moment. $54,913. Okay, I got it. So actually, that's the right number. So we're talking about 70,188,000 US dollars. 70,188,000 US dollars seems high. I mean, it is for sure high. And when you take a look at it, past quarter it grew by 22%, this quarter roughly by 28%. So it's accelerating, and of course we want to see in this regard that the growth is low and not high. However, when we see stock-based compensation based on the revenue, it was past quarter 33%, it is now 33%. It's just a bit lower than past year, but it's not decreasing that heavily like past quarter year on year. So again, even here, because I would love to see it's getting more and more lower, maybe 33% is the standard right now, and it's just the base what they want to utilize. I want to see it lower, and it's not getting lower, so I take this as well negative. And now we check out what is going on with the futures. So taking a look at the full year guidance, going back, guidance, I mean, we already had it, page 13. Okay, so full year guidance, revenue 880 million US dollars. Before it was 815, so they expect actually a higher one, which is great. So that's definitely something delicious. That's definitely something positive. Correction to the upside. Something nice. Gross margin non-GAAP 79%. Let's see. I mean, when we talk about this results, obviously the profitability, the margin efficiency is not that strong. But we will have it in a moment, and you can see here it stays at 79%. So let's go back, and I mean that is okay, that's neutral. Last but not least, operating margin non-GAAP for the full year -4%. Going here as well back, and you can see it here on the first glance, it stays on -4%. Getting actually a little bit lower expected for the next quarter, but yeah, -4%. So adding this as well, neutral. So we rate the full year guidance neutral. And I mean, guys, that's basically already it. I mean, they enter a lot of information always about what is going on in terms of their technology, and sometimes they argue about why sometimes something happens. You can see here Sentinel Labs, what is going on, what is the research, what is the new developments, the product portfolio, some highlights about how they're entering now, what kind of, you see a partner with Lenovo, which is definitely a great achievement. Then we had here, as you can see here, the FedRAMP. So basically they are qualified, I think, for doing business with the government. Yeah, so that's great to see. And here partnership with Amazon Web Services, so their cloud businesses. Some stuff is going on for sure. I can recommend, if you are investor or you are interested to invest into this company, to read this document, and even more important, check out the call, how they reply on the questions by the management. But look, guys, when we now go quickly through it to find a final verdict, yes, I mean, to see it on a very sober, neutral, objective scale, already on the first glance, it's definitely not perfect. Bottom line growth, top line growth, both I rated negative, definitely. Expectation forecast not that bad, but revenue beat was really not that great. And yeah, EPS, we don't need to even start. Not 100% sure if that 0.25% minus is correct. Please check this out by yourself. But it's definitely a miss, no matter how I calculated it. And that is for me as well a negative rating. So profitability is way more lagging than revenue, even both is negative rated, but this is already for sure a bad start into a verdict discussion about these results. And now we check out international revenue, yeah, on a solid scale. ARR actually is developing quite fine. I mean, no matter if we talk about the overall SaaS revenue under contract or the customer base of the larger customers. So it seems that they are competitive actually even in the large companies environment. So that's looking great. So revenue is not that big problem, let's say like this. But when we start with the expenses, it looks really not convincing, really not good, not attractive. What you don't want to see, you want to see really these jumps getting lower and lower, and somehow it's getting more and more higher, or not developing that aggressively. So that's straight negative. And of course, when the expenses are not developing great, operating income margin is not developing great, that's obvious. But as well, cross margin not looking that great. Free cash flow, yes, that's a positive surprise. That's nice to see, and I hope they will achieve more and more consecutive quarters and results in a positive manner. in terms of free cash flow margin in the future. But that is really at least some light at the end of the funnel. Rule of 40 again bad, basically because of the revenue growth year on year, which is not that compelling with 28.4%. Stock-based compensation is still very high, kind of unfriendly to the existing investors because of the resulting dilution. Good for the staff members, of course, and hopefully they are more motivated by this. And full year guidance actually not that bad. I mean, that counts on the midterm. I mean, when they keep it, they can keep it. They can keep going it and doing it. And wait one moment, I want to check quickly what was the guidance for the next quarter in terms of 79% gross margin for the next quarter. Okay. Non-GAAP, of course. Yeah. However, full year guidance is okay. It's good. They adjusted up the revenue, I think, just by 3 million or something like this, but at least they did it, so that's great to see. However, I mean, just because of this, it's very difficult for a company to somehow shine with details, to shine with those details. But even the details are not shining that much. I'm quite happy that the guidance seems stable. That is for me very important at the end, because we want to see that this company is growing, developing well. Of course, we would love to see more positive surprise. Not sure where it is lacking. Not sure why the expenses are that stable and not decreasing. That's the definitely. I mean, if the expenses would be fine, a lot of other details here, and for sure the EPS would look better. I think that's definitely the game changer, the KO criterion for this call. However, I already used the word KO. It's not the worst. It's not for sure not the worst earnings results I backed here with a live earnings episode, but for sure as well not the best. So I rate this basically straight negative, and I just hope that it's getting better in the future. And I understand that now. Let's see what is going on with the current price. I understand that it was 14% negative, and it is very likely a little bit less. Again, it's not like a complete crash or something like this. I mean, expectations again have been high. I think you can see 4% up before market close. So the market, I assume they expected some kind of a beat, a surprise. Crowdstrike had a double beat in terms of earnings per shares, or in terms of profit and in terms of revenue. Unfortunately, SentinelOne couldn't make it happen. You can see the time is correct, 14% negative, looks correct. So yeah, after hours, market is not liking it. I can imagine that it's getting even a little bit more down tomorrow. However, again, my favorite sector, I like SentinelOne very much. I like how disruptive they are, that they have a very nice approach. And I can imagine that they just basically need a little bit more time developing great. It's not my strongest convinced investment, but you can see here when you compare, look, I compared here with the power of seeking alpha different cybersecurity companies like direct competitors Crowdstrike and Palo Alto, or Zscaler, Trend Micro, Okta, CyberArk, and Checkpoint Software. And when you check out the price sales ratio, especially from Crowdstrike, which is really in terms of especially endpoint security direct competitor, and with S, so orange and blue, and right now I'm not sure if I can tell you, because I think you can't see it in the screen or just very bad, but the price sales ratio of Crowdstrike is currently roughly 23, and of SentinelOne it's roughly 12. So more or less 100% up potential. And yes, Crowdstrike is performing very well on another scale, has well more different products and services what they offer. It's just simply more major company, let's say it like this, and of course as well more profitable, for instance. I understand it's not like SentinelOne should have as well a price sales ratio of 23, but you see there is definitely some room for improvement. Even a company like Palo Alto Networks, which is here the purple color, it's about 15, so even there is room for some upside. I think I can imagine at least that the stock will now drop a little bit further as well in the future till the next earnings results, and I can imagine that, and I'm again non-professional, it's just entertainment, no financial advice or whatsoever, but I don't think there will be this strong impulse, this positive initiator for that the stock is raising. Yeah, it's getting higher and higher and more costly, the stock price. I don't think that will be the case in the upcoming 2 months, or 2-3 months till the next earnings results will be released, full year 2024 earnings results. I don't think that will be the case. I can imagine it's dropping a bit, then staying stable if there are not some news from competitors or from SentinelOne itself. And I can imagine that when the results are fine of 2024, at least the stock stays more stronger or even further stable. Maybe even the price is increasing again. I can imagine this. So I stay patient. I don't hope some awkward news getting on the surface in these terms. I don't want to have too much trouble and just relax as a stock investor at the moment, I need to say, and just waiting for harmony and Christmas time. So hopefully SentinelOne is not putting under the mistletoe tree some bad presents. If that's the case, it's the case. I mean, you should not always be invested in one company. I mean, you can do whatever you like, but even though I have a high focus and I only have something like 12, 13, 14% invested in SentinelOne, so if it's going down by 10, 20%, not that nice, don't like to see it, but it's not like the world is getting completely cancelled. That's not the case. Guys, if this session was acceptable, even if I was a little bit late and even I wasn't prepared that well, promise that will be better at Q4 2024 earnings. However, feel free to like and subscribe to the channel and like, of course, this video. And of course, feel free to follow me as well on my social media accounts, A Sense of Capital on Twitter and on Instagram. I keep you always updated with new purchases. Like I think yesterday or the day before, I purchased for roughly $1,000 shares of new digital bank in Brazil. And guys, I'm very glad that you have joined. I hope it was okay for you, even it was a quite short period, short episode. Looking forward to latest see you again in February 2025 when we're back. I think we start again on 14th of February, so Valentine's Day with Hims and Hers, which is running crazy and at least covering the losses in terms of SentinelOne for me. Yeah, and actually that means that this earnings season is over. I'm quite happy with the results. I mean, we can quickly check that so far only Elfen and now SentinelOne I rate a negative, but Grab, Hims and Hers, New and Stoneco, all of them I rate them positive. So it was quite I think it was the best earnings season or the best earnings results I ever had actually, even though now the end with SentinelOne is not the most positive surprising one. It is how it is, part of the game when you are an investor, and yeah, where sunshine is a shadow, of course, so philosophic. However, yeah, thank you very much for joining, guys. Again, this was not financial advice, consultation whatsoever. And most important, as always, is that just take care of yourself and stay healthy. And yeah, I hope I see you next time in latest February. All the best. Cheers and bye. A sense of capital.